Usually, the stock market is just a simple scorecard, Print money, your stock goes up.
Right. It's supposed to be entirely logical.
Exactly. You start losing market share, your stock goes down. It is clean. It makes sense. But today, we are looking at a company that practically owns a $120 million market.
Yeah, and operates with this just jaw-dropping 81% profit margin.
Which is insane. And yet its stock just plummeted off a cliff. We are looking at, honestly, one of the greatest market contradictions of the year.
It really is.
So, okay, let's unpack this, because the sheer scale of the disconnect we are diving into today for you listening, it's just staggering.
Yeah, the divergence between the actual financial reality and the stock chart. Right now, it's extreme. You rarely see this kind of massive valuation gap in a mega cap company.
Right. So exactly how extreme is it? Let me just lay out the paradox for you. We are looking at this mountain of financial data, sentiment analyses, technical indicators, and it's all centered on Novo Nordisk.
One of those dominant healthcare giants on the planet, basically.
Literally. Yet this behemoth just watched its stock plunge 8.77% in a single trading session. It gapped all the way down to $47.08.
Which is brutal.
Yeah, and that drop leaves the stock sitting an unbelievable 89.5% below its 52-week high of $450. Like, it is hovering dangerously near a technical low right now.
Which is just a violent repricing for a company of this pedigree. And it sets up the core question we really need to answer today.
Right.
What's fascinating here is how, when a stock with fundamentally sound underlying businesses drops that drastically, the market is usually just overreacting to a localized issue.
They get tunnel vision.
Exactly.
Yeah.
They're staring so intently at one broken gear in the machine that they completely ignore the massive, highly efficient cash-generating engine that is just, humming along in the background.
So our mission today is to figure out if catching the stock right now is like grabbing a falling knife, or as some of the analysts in our sources are loudly claiming, a genuine generational buying opportunity.
Right, the stakes are high.
Very high. But to do that, we have to start with the drop itself, because an 8.77% gap down in one day, that does not happen by accident. What was the trigger? Like, what news actually hit the wires to spark that level of immediate panic?
Well, the catalyst was a clinical trial failure.
Okay.
Specifically, a trial known in the pharmaceutical world as the ZUS trial. They were testing a drug called ziltivekimab.
Wait, I am going to need you to break that down. What was this drug actually supposed to do?
Right, so the goal of the ZUS trial was to determine if this drug could reduce major adverse cardiovascular events in high-risk patients.
So heart issues.
Yeah, we are talking about preventing severe, life-threatening incidents like heart attacks, strokes, cardiovascular death in a highly vulnerable population. And the clinical data came back definitive, but in the wrong direction.
Oof.
Yeah, the drug completely failed to meet its primary objective. It just did not provide the necessary cardiovascular protection.
Man, in the pharmaceutical sector, a late-stage trial failure is always rough. But how bad is the immediate financial damage?
Well, the immediate consequence is basically an accounting hit. Novo Nordisk announced that they will have to book a non-cash impairment charge in their third quarter.
Okay, let me stop you there for a second, because non-cash impairment charge, that sounds like total Wall Street jargon to me.
It does, yeah.
Does that mean they are actually losing money from their bank accounts today? Or is this just like a paper loss?
It's entirely a paper loss. Think of it like buying a house for $500,000 and then an appraiser comes by a year later and says, actually, it is only worth $300,000.
Right. You didn't physically lose 200 grand in cash from your wallet that day.
Exactly. But you still have to adjust your personal balance sheet to reflect the new reality. Novo Nordisk spent money developing this drug, holding its potential value on their books.
Got it.
Now that the trial failed, they have to write down that value. It hits the earnings report, sure, but it doesn't drain their current cash reserves.
But the bleeding doesn't stop with just this one trial, right? Because the notes mention this failure creates a massive domino effect for the rest of their cardiovascular pipeline.
Oh, absolutely. Analysts from BMO Capital Markets, who track this space heavily, they immediately downgraded their expectations.
Yeah, they don't waste any time.
No. There are 2 remaining studies for this same drug, Hermes and Artemis, which were expected to report data in the first half of 2027.
And now?
BMO has now concluded that positive data from those upcoming trials is, quote, highly unlikely.
Wow.
Yeah, when the lead trial fails this spectacularly, it usually just poisons the well for the subsequent studies using that same mechanism.
Okay, I hear all of that, but I have to play devil's advocate here for a minute because the math is really bothering me.
Go for it.
If the stock is down 89.5% from its high, and it just dropped almost 9% in a single day on this news, it feels like a superstar athlete who just missed a single free throw, but the market is acting like they just completely tore their Achilles tendon.
That is a phenomenal analogy.
Right, like, are investors actually right to panic like this? Was cardiovascular supposed to be their next big savior or something?
And that gets right to the heart of the market's current hysteria. To understand if the panic is justified, we have to contextualize what ziltivekimab actually means to the company.
Okay.
Novo Nordisk is not fundamentally a cardiovascular company. That was an expansion play, a side quest, if you will.
A side quest.
Their undeniable core moat, the foundation of their entire empire, is built on obesity and diabetes treatments, the GLP-1 market.
Right, the Ozempic and Wegovy engine.
Yes. And when you pull back from the ZUS trial failure and look at the fundamental reality of that core engine, the metrics are staggering. We're looking at a trailing 12-month revenue growth of 8.13%.
Which for a mega-cap company is an incredibly heavy ship to keep moving at that speed.
It takes immense momentum, but the revenue growth isn't even the most impressive part. It is the margins. They are currently operating with a gross margin of 81.85%.
Wait, let's pause on that. 81.85% gross margin. So for every dollar they bring in, nearly 82 cents is gross profit before they even pay for operating expenses.
Exactly.
That is the kind of margin you expect from a software as a service company where the product is just, code in the cloud. How does a company manufacturing physical, highly regulated, temperature-sensitive drugs achieve an 81% margin?
It comes down to absolute pricing power and just unprecedented economies of scale. When you have a drug that the entire world is clamoring for, and you have perfected the manufacturing process over years, your cost to produce each additional pen or pill drops dramatically.
That makes sense.
And that efficiency cascades down the income statement, leaving them with a net margin of 37.2%.
That translates to just an absolute river of free cash flow.
A river that acts as a massive shock absorber. Going back to your basketball analogy, the core engine doesn't even feel the bump of the missed free throw.
Because they generate so much cash.
Right. Novo Nordisk can absorb the ziltivekimab trial failure and the subsequent write-downs without breaking a sweat. In fact, management went on record confirming that this cardiovascular failure will not affect their adjusted operating profit outlook for 2026 whatsoever.
So the headline screams disaster, but the actual cash register hasn't skipped a beat. And the runway for that core business is mind-boggling. Our sources project that the total addressable market for GLP-1 treatments is going to hit $120 billion by the year 2030.
We are witnessing the expansion of one of the fastest-growing therapeutic classes in modern medical history.
And here's where it gets really interesting. They aren't just coasting on the injectable pens anymore. In January, they launched oral Wegovy, basically a pill version of the weight loss drug.
Yes.
And the early data in the sources shows it has already captured an 89% share of the U.S. oral GLP-1 volume. 89%. They essentially launched a product and immediately monopolized the category.
Well, the transition from an injection to an oral formulation is a structural game changer. It secures a profound first-mover advantage against their primary rival, Eli Lilly.
Because, practically speaking, taking a pill with your morning coffee is just infinitely easier for a patient than dealing with needles, right?
Exactly.
Managing injection site reactions, keeping medication refrigerated, it's a hassle.
It removes massive psychological and logistical barriers to treatment. Patient adherence skyrockets. But look at it from the business side. It creates incredibly high switching costs.
How so?
Think about the dynamics in a doctor's office. If a patient is successfully losing weight on a daily pill with manageable side effects, neither the patient nor the doctor has any incentive to switch to a competitor's injectable drug. You lock in that revenue stream.
Oh, wow. Yeah, that makes total sense.
And for any new pharmaceutical company trying to enter the space, replicating Novo Nordisk's oral manufacturing scale and distribution network is nearly impossible.
Okay, so if oral Wegovy is flying off the shelves, locking in patients, and they have an 81% gross margin, the natural assumption is that they are swimming in near-term profits.
Right.
But that's exactly where this story takes a weird turn in the notes. We have their upcoming Q2 earnings approaching. They are projecting 71.5 billion Danish krone in revenue and 5.04 in earnings per share.
Yep.
But analysts are forecasting that the U.S. EPS will actually be down 16.5% year over year, sitting at just 81 cents. I am struggling with this math. If demand is off the charts, why is the profit shrinking right now?
I know, it looks like a contradiction, but it is actually the hallmark of a company playing the long game. If we connect this to the bigger picture, that 16.5% contraction is not a symptom of weak demand, pricing pressure, or a broken business model.
Okay.
It is the direct result of heavy, aggressive capital expenditures.
So they are actively spending the profit. On what?
Manufacturing infrastructure and global launch costs. When a drug goes viral the way Wegovy has, your primary bottleneck isn't finding willing patients.
Yeah, everyone wants it.
Right. Your bottleneck is physically producing enough of the active pharmaceutical ingredient. So Novo Nordisk is taking that massive free cash flow and pouring it straight back into building new factories and scaling up supply chains.
But at what point does building all these factories eat so much of the cash that the 81% margin stops mattering to the actual shareholder? Like, is there a risk they are overbuilding?
Honestly, the risk of overbuilding is minimal compared to the risk of stockouts in a $120 billion market. If you don't supply the drug, Eli Lilly will.
That's a good point.
They are sacrificing a fraction of near-term, on-paper profit to build the industrial capacity required to capture and hold that future market share. But they aren't just investing in concrete and steel. They are pouring billions into pipeline innovation. They are actively funding the drugs that will eventually disrupt their own current portfolio.
You're talking about amycretin.
Yes, amycretin is a perfect example of how you extend a moat into the next decade.
The sources refer to it as a, quote, dual GLP-1 and amylin receptor agonist, which sounds incredibly complicated. How does that actually work in the body, and why does it matter?
Think of the current GLP-1 drugs, like Wegovy, as the brake pedal for your appetite. They mimic a hormone that tells your brain you are full, slowing down how much you want to eat.
Okay.
Amylin, on the other hand, is a different hormone that physically slows down gastric, emptying basically how fast food leaves your stomach.
Oh, interesting.
By combining both into one molecule, amycretin doesn't just tap the brakes on your appetite, it puts up a physical roadblock to overeating. The early-stage clinical data shows this dual-action approach has weight loss potential that could significantly surpass the current generation of Wegovy.
So they are deliberately spending billions to invent a better, more powerful drug that will cannibalize their own best-selling product.
Yep.
Just to ensure that when the market inevitably evolves, they are the ones leading the disruption, not a competitor.
That is exactly how monopoly-like power is sustained in the pharmaceutical industry.
Okay, so we have a massive disconnect. A failed cardiovascular trial on one hand, and this unstoppable, highly profitable, forward-looking weight loss engine on the other.
A total contrast.
Right. So what does this all mean when you look at how the broader market is digesting this? The sentiment feeds are completely bifurcated.
It is a total split personality in the financial media right now.
It really is. You have feeds blasting headlines like Novo Nordisk announces ziltivekimab did not translate into risk reduction, painting this apocalyptic picture.
Right.
But then on the exact same Alpha Vantage and FinHub data feeds, you have analysts literally calling the stock a generational buying opportunity. How does the average investor reconcile those two extremes?
You reconcile by looking at the valuation floor. Because of this massive sentiment-driven sell-off, the stock is currently trading at a price-to-earnings, or PE ratio of just 11.
Let's give some context to that number. A PE of 11 means you are paying $11 for every $1 of earnings the company generates. For a high-growth pharmaceutical company with an entrenched global monopoly-like position, a PE of 11 is practically unheard of. Usually, these companies trade at multiples of 25, 30, or even 40.
It is historically cheap. It is hovering near an all-time low valuation for the company. And when a high-quality franchise, one that prints cash with 81% gross margins, hits a depressed PE level of 11, it creates a very strong valuation floor.
Because it's just too cheap to ignore.
Right. At a certain point, the downside becomes limited because value investors and institutional algorithms step in to buy, simply because the underlying math becomes too lucrative.
Are we actually seeing evidence of that in the trading data? Like, who is selling to drive the price down 89% from its high, and who is stepping in to buy?
The technical data tells a fascinating story of retail panic versus institutional patience. Our notes highlight the squeeze watch indicators, which track the flow of shares from company insiders and large institutions.
Okay.
Over the past 90 days, insider net shares are at exactly zero.
Meaning the executives, the board members, the scientists, the people who actually know the day-to-day reality inside Novo Nordisk. None of them are panic selling their own stock, even as it hits these lows.
If the company were truly facing a structural collapse because of the ZUS trial, the insiders would be the first to hit the exit.
Right.
They aren't moving. Furthermore, look at the trading volume during this 8.77% gap down. It is surprisingly subdued, trading at just 0.76 times its normal 3-month average.
Wait, why does low volume matter on a red day? Doesn't a big drop just mean everyone is selling?
Not necessarily.
Yeah.
High volume on a massive drop indicates institutional capitulation, meaning the mutual funds and pension funds are dumping millions of shares.
Ah, okay.
Low volume on a sharp drop usually points to a sentiment-driven sell-off. It means retail investors are panicking over headlines, and trading algorithms are adjusting their bids lower, but there is no heavy, sustained selling pressure from the major players.
That's a huge distinction.
It is. In fact, the scanners are picking up the opposite. They are tracking what we call whale activity in the options market.
Options are essentially contracts betting on the future price of the stock. So whale activity means massive, multi-million-dollar bets being placed.
Right. While the retail market is panicking over the cardiovascular news, the scanners show large, sophisticated transactions happening quietly at these depressed levels.
Interesting.
It strongly suggests that institutional smart money is using this volatility to accumulate shares and build positions at a steep discount.
And there is also the rumor mill adding fuel to the fire. Because when a pharma giant with massive free cash flow hits a pipeline setback, they usually don't just, accept defeat.
No, they don't. The notes from BMO Capital highlight increasing speculative pressure on Novo Nordisk to pivot toward large-scale mergers and acquisitions.
So if your internal cardiovascular drug fails and you have billions in the bank, you just go out and buy a smaller biotech company that already has a successful cardiovascular drug.
It is a classic pharmaceutical playbook. They have the balance sheet to execute a major acquisition without jeopardizing their financial stability.
Wow.
If they announce a smart acquisition, it would instantly change the narrative, plug the hole left by the ZUS trial, and act as a massive re-rating catalyst for the stock.
Okay, let's pull all these threads together. We started with what looked like a disaster zone, right? A stock down 89.5% from its peak, dropping another 8.7% on trial failure news.
It looked bad.
But when we actually dug into the sources, the data gave the setup an 8 out of 10 bullish score. The core thesis here is that Novo Nordisk is a multi-year hold. The market has completely mispriced the stock because it is hyper-focused on the failure of a non-core asset.
Exactly.
Meanwhile, the actual cash cow, the GLP-1 obesity and diabetes franchise, is capturing 89% market share, generating 81% margins, and securing its future with next-generation drugs like incretin.
Investors just need time to digest the ZUS headlines and re-underwrite the growth story. The 2027 catalysts, like updates on the remaining cardiovascular trials and their other pipeline assets like CagriSema, give patient capital a massive amount of upside to look forward to.
And this raises a really fascinating macro question.
It really does. This raises an important question, and I want to leave you with one final thought as you look over your own research.
Go ahead.
Right now, the broader financial world is obsessed with macroeconomic data. Everyone is hanging on every word about interest rates, the monthly jobs reports, inflation data. But historically, healthcare stocks, especially those providing life-altering medications with entrenched monopolies, tend to decouple from that macro volatility.
Because if you rely on a medication to manage your diabetes or severe obesity, you are going to find a way to get that prescription filled regardless of what the Federal Reserve decides to do with interest rates next month.
The demand is inelastic. So here's the question you need to mull over. In an incredibly uncertain economic environment, could a deeply discounted, highly profitable healthcare stock like Novo Nordisk actually be the ultimate defensive play?
Disguised as a risky falling knife. That is a brilliant way to frame it. What happens to the broader market if investors wake up and start treating these massive cash-generating biotech pipelines less like volatile tech startups and more like reliable utility companies?
It completely changes the game.
It forces you to look past the jagged, broken line on the stock chart and look at the actual underlying health of the business. The market might be screaming that the sky is falling, but the data tells a story of a cash-generating engine that is just getting started. I highly encourage you to keep digging into these financials, the options activity, and the pipeline data on your own. There is so much more to explore here. Thanks for joining us on this deep dive, and we will see you next time.